It's a good start. It's a strong start. It's a decent start. Benchmark indices are off to something quiet, but mid-cap stocks, they continue to do something special. You want to pick up some stalwart stocks now. What was in demand yesterday? Tata Communication, we discussed this one. What really was in the eye of storm, so to speak, Z. Tatacom is off to another great start. That makes it 1600 plus. And then you flip it around with Z, which was at the center of the storm. And Z is off to a good start. It has recovered 7-8% from yesterday's low, and I think Plutus is a fund where the blog deal is indicating that 90 lakh shares they've acquired from the open market yesterday, and that's a large commitment coming by any large investor. So Z is off to a good start. Dalmia International is off to a flat start. Not too many newsmakers here, but you want to check in on some of the real estate stocks once again, some of the ONC stocks once again, because they've been in a sense getting a lot of action and attention.
Yes, just wanted to highlight Vodafone idea because that's definitely starting on the front foot. That entire fund infusion has taken the stock high by 7%. Okay, now it's fizzled out, but still 5% higher. KEC is the other one. There's an order win of around 1300 odd crores. So that's supporting the sentiment on KEC International. You also have Indus Towers apart from Tata Communication, which is in focus. So that stock has also opened on the front foot. On the losing side, CDSL, that stock is down 4%. Tata Chemical, of course, took that price cut of soda ash, and that's the reason you are seeing a cut of almost 3 to 4% on that stock. Remember, after Nirma, it's Tata Chemicals, which has taken a price cut of almost 2,300 rupees per metric ton, and that's the reason that stock is down about 3%. KPIT Tech had taken a sudden knock yesterday at the close of the session. Today as well, it's opened on the back foot, Aisha.
And the LOI worth about almost 2,200 crore rupees with the Japanese specialty chemical company as well. 4.5% move on Anupam Rasayan. Zydus Life, wherein the US FDA has now issued nil observations for their injectable manufacturing facility at Changodar. So that is another stock which is in focus. And then, of course, there's Z. It seems that Plutus Wealth Management has bought 75 lakh shares at in a block yesterday at 191.4. So there has been a lot of buying that one has seen in Z. It's climbed up to 197 plus levels already, that stock in trade. This Tata Chemical, which Anisha just highlighted, this PM Industries as well, there's been a fire at their Sonipat plant yesterday, or one of their units actually. Balkrishna Industries, which has suspended operations at their Gujarat plant because of the cyclone Biperjoy. So that's another stock in focus. And Dhampur Sugar, they've completed an expansion of their distillery capacity at the Dhampur unit. So that's another stock which has moved up by about almost 2%. But let's also see where the buzzers from yesterday are. How can we not talk about Trend, Tatacom, even ABFRL and Loris Labs? All these stocks held out very smartly yesterday. MRF made it finally to that 1 lakh per share mark. Let's see what that stock as well is up to. And then, of course, the weakness which continues on a Kotak, on an Adani Enterprises, Interglobe Aviation, which fell 3% yesterday. Let's check in on that stock and what it's currently up to. But it's a sedate start. I don't think one can complain really, Kunal. What trades are you punching?
Yeah, I think it's an okay start for the index. So we should be hovering at least above the 18,650 mark on the spot levels. The trade which I would look to initiate at current levels would be United Spirits. The stock yesterday also showed good forward. It's come back towards the 890-900 zone. So the earlier resistance was 800 for United Spirits. Now the resistance is closer to 900 mark. Looks attractive from a near-term play.
Vikas Khemani joins us. Let's connect with him. Let's talk markets, stocks and ideas where he's currently excited about and he's investing. Vikas, good morning. Thank you for joining us. It's a different look, Vikas. As the market changes, your look also changes.
It is same, bro.
No, I mean, a year ago, if I take out your old picture versus now, markets were different and your look was different. So you change your look with the markets now, is it?
Time change, boss. You keep evolving with the time. So, you remain same over the years. Young, dashing, as always.
No, sir. Very kind of you. I guess I think the constant view what both of us have is markets are headed higher and the best of India is yet to come. I think that's the motto which you would endorse, and that's the motto of ET now. But long term aside, let's talk about the current scenario. We've had a good comeback. a sizable comeback. Benchmark indices are at a new high. To your mind, what is driving this sugar stroke liquidity rush into India, and do you think this is here to stay?
I think Nikunj, very good question. And if you remember our conversation some time ago, and we had written a note also on this, as we've said that inflation, interest rates, and dollar has peaked out. It is always coincided with the flow towards emerging market. Whenever Fed raises interest rate for whatever reason, foreigners pull out money from the emerging markets because most emerging markets run current account deficit economies, and any rise in the interest rates in US impacts them through inflation and weakening currency. So that's a typical template most foreigners play over the years, last 30, 40, 50 years. And same thing, as and when that rate peaks out and starts turning back, emerging market receives that flow. So at this, we've been making this case pretty much same that our sense has been last 4 or 5 months that inflation has peaked out. Thereby, it means interest rates have peaked out, and thereby, most of the flow which went back over last 2 years, which is almost 40-45 billion dollar, will come back. And in fact, I would say there would be more flow which will be coming back. For the simple reason, in emerging market basket, India stands out. So I see a situation where both, as the interest rates right now, the sense is peaking out, and in my opinion, over the next 1 to 2 years, you will start seeing interest rates coming down. So you will see this whole money flow coming back to India, and this time around, not only overall emerging market basket returning, but India will get larger proportion of the emerging market share. So what we have seen in terms of flow is just a beginning of a very long trend. And this you can go back and check history, tells you this. So I am quite optimist. I have been quite optimist. I continue to remain very optimist on the liquidity, especially towards the Indian markets.
Is the red flag then? Markets cannot go up like this. Corrections and volatility would be par for course, so to speak. What to your mind would be the red flag? For example, if somebody spoke about valuations in 2020, it had become a red flag. India was a great story, but valuations were haywire. How far are we away from euphoric stroke expensive valuations now?
So, valuation is function of two things. One is, your earnings growth, and second is interest rates, right? So, earnings growth, and interest rates. These are three major factors in the valuation, right? If you look at, earning is reasonably stable. I think we are seeing 15-16% kind of range over at least next 2-3 years. CAGR looks visible, and interest rate scenario is looking down. So, it is very, very kind of natural that India will get re-rated. And if it is backed by your liquidity, will get further re-rated. So my own view, and other thing which I would like to say, that a 2% drop in the interest rates increases the equity valuation by 35%. And this is a very less intuitively understood factor. And hence calling out market looking at only the historical levels will not be great. So I would say India is not expensive. India is not cheap. It's in a kind of a fair value zone. And as liquidity builds, as liquidity comes, because the thing is that Indian liquidity is not going anywhere. So Indian liquidity remains solid, and at the top of it, you are getting the international liquidity. And that, in my opinion, over next 2 years will build a euphoria. There will be a situation where we are going to see a much more euphoric environment than what we are. Intermittent corrections will happen in this phase. There's no denial from that, because that is what markets are made of. But I remain, in a shorter term as well as medium term, quite optimistic on the market.
Let's talk stocks then, because this is increasingly big, becoming a very stock specific market. Even within sectors, one is seeing not any stock is outperforming. It's not linear in that sense. And I can spot capacity infra, wherein very recently you bought a sizable chunk. Just yesterday we heard of Society General as well picking up some shares in this one. What excites you and interests you about capacity?
I would like to stay away from any stock-specific comments.
Sure. But as a theme, why is it that you're bullish on it?
So as a theme, I think if you see the India needs to be built, India is being built. Massive amount of spend is happening on the infrastructure space, construction as a space, right? And in over last 4, 5, or 10 years, a lot of consolidation has happened. happened in the sector. Many companies have gone out. It's become very consolidated sector. There are very few good quality players who could execute, deliver on time. So, like anything else, and this is happening by the way many sectors. So these solid players who can deliver, who can build, who can execute are kind of getting better and stronger. And same thing is happening, applying to this space. And I'm assuming. And then you have to do work, of course, on the quality of the management, company's capability, which is the key factor from delivery perspective.
And you've time and again spoke about as to how India is set to become a manufacturing hub over the next decade. How else, as an investor, can you cash in on this?
I think one is, of course, the players who are sitting in the middle of this trend. It's like this, when IT trend started in mid 90s, the best way to play was to invest into companies which were benefiting from the IT segment, and there were a lot of Indian IT companies which became big. So I think Indian manufacturing is coming of age. It is only getting better in favor of India from cost competitiveness perspective, from demand environment perspective, and what we have seen, despite whatever returns have been delivered by the market stocks in this space, a very, very long way. So I know one should not get discouraged by saying that stocks have already done well and how much more left from here. So all in the companies in the import substitution space, export oriented space, be it in auto components, specialty chemical, or defense, or garmenting or footwear manufacturing, capital goods. I mean, it's a very wide area which is going to benefit, and that's the beauty of it. So, and you will see many companies becoming, in fullness of time, 10x, 20x, and that happens, by the way. I'm not saying something new, it has happened in every cycle, and so would happen in this. So I would say that, companies who are with good capability, good management track record, should benefit and will continue to benefit over. And I do see a scenario when there will be kind of a lot more money coming into it. And the interesting part is that, manufacturing is never one way. It comes with a cycle, right? Like in 21, chemicals was a completely euphoria. 22, we saw they're dying down, and today there's very less interest in that. But in my opinion, you will find many specialty chemical company, APIs company in a very, very sweet spot, and you will see them doing well over the next 2 years because the trend doesn't change. So I think one has to remain very sane and balanced about how to build a portfolio, but the trend is here to stay for from a very long term perspective.
Vikas, also wanted to understand your view on pharma because that's the dark horse we have been talking about. And if I have it right, you're positive on a couple of names like Loris, Syngene, etc. I know you can't talk stock specific, but nonetheless, the themes you're watching here?
Absolutely. So I think we've been more than pharma. See, pharma is a very generic subject. It's very wide, and there are lots of nuances in that, right? So within pharma, your domestic pharma with the exposed to international formulation, generic formulations, then API companies. So then CDMO, CMO. So I think they're very, very wide, and each of them have a very different business dynamics and return profile. So we've been quite bullish on specialty chemicals, bullish on API as a company, with of course as a segment, CRO, CMO. So all those segments we find very, very sticky and long-term perspective. Of course, 22 was a year where a lot of corrections happened because 21 was a very big year for margin expansion, inventory accumulation. All those corrections have happened, and now these companies are kind of sitting on a very nice pace. So we continue to remain bullish. We have added some to our position where we felt that corrections was overdone. So that's how, and we remain quite positive on this from a medium term to long term perspective.
I'm going to talk about one of your portfolios, that's the Structural Shift Fund. And this is where the real interesting mid-cap names are there. You got Anup Engineering, Tejas Networks, Jet King, Newgen Software. Are these company-specific structural shifts you're betting on, or is there an underlying theme, which in a sense is the umbrella theme for this portfolio?
So this portfolio is a theme about Nikunj. Again, like I said, that in this 70 to 75% we invest into manufacturing. The same theme which I spoke about, which benefits from the import substitution or export or a combination of both. And the second part is in the technology space, and technology also we prefer where it sits in between manufacturing and IT. So companies like Cyient, we are very strong in ER&D and focused on aviation as a growth driver. Companies like Tejas Network, which are more the telecom equipments, and strong R&D company. So whatever So either they are pure tech company or sitting between manufacturing technology, benefiting from this overall theme. And we have a strong conviction. We've been having this conviction for 2 years, over 2 years now, and we continue to believe that it's a decadal trend. And we continue to outline again and again that please do not mistake this with a short-term trend. A massive amount of wealth will get created, and of course, you have to keep identifying companies which will benefit from them. The key conditions being you have to know the business model, and more importantly, the management, its capability, intention, the quality. And we focus in identifying a lot more on the quality of the companies and business model. That is where our, so all the companies which you are seeing in our portfolio passes that test.
Any defense names here, big bet on manufacturing. I don't see any railway names here, big bet on capex. Any reason why you avoided PSU railways and defense names in this portfolio?
So I think we have some names. Again, if you can't play direct play, because in my opinion, instead of defense, in defense there's huge euphoria going on right now. Most names are trading beyond our comfort of valuation, and we believe that again they are cyclical. They will. I mean, there's huge euphoria, so you kind of have to be very careful. We play. We have companies like Timken in our portfolio, which benefit from the railway, defense, everything, and industrial capex. So it is indirect play would one could play, and again a very good sector, good management. So we try to kind of, for us, business management and valuation is also very important. We are a quality at a reasonable price house. We are not quality at any price. So we focus a lot on, ultimately we believe that risk reward is very important. We have to make money. We doesn't have to merely show just the portfolio for the namesake. So, ultimately we are very conscious, and in defense, we find that right now, euphoria is there, just like how we saw in chemicals in 21.
Before we let you go, a quick word on the IT space as well. You've been quite positive on that. You have names like Cyient, etc. in your portfolio. But this morning as well, there was a JP Morgan downgrade coming in Persistent Systems, which is down about 3%. The entire IT space actually is on the back foot. Is it a time to buy IT, or just hold your horses and there'll be better opportunities to buy?
No, I think we've been very positive on IT for some time. Nikunj know this, and I here is an interesting take on IT I can share. Our whole view also is that IT is also a good play on interest rate down in the US market. See, today in IT, whatever is happening, whatever order book accretion we have seen in last 12 months, 18 months, mind you that has happened in the middle of a pessimism or recessionary kind of mindset across the board. So if any company is giving order, they are giving more survivor order, must order to be given, because in that kind of environment, no CEO would spend money which is for futuristic kind of plans, right? When the environment is so bad, the growth orders are yet to come. Growth spend is yet to come, and as the environment in the US settles down, which could be 6 months down the line, 12 months down the line, I don't know, but I have a firm conviction that we will start seeing once the number prints out. I mean, interest rates coming down, and as that happens, IT companies will even see an acceleration on the growth. So, and reasonable valuation, good dividend yield stories. So in your portfolio, you've always got to have a bit of a balance. And our conviction is, and in IT also, every cycle you will find some companies becoming big. Like in 2009 to 15 cycle, companies like HCL Tech, Mindtree, LTI, they became very big, right? I mean, they became 8x, 10x, right? So we think that in this cycle also, some companies will become very big, over a 5-6 year period. So history repeats itself. So our idea, our endeavor is to look and invest into those kind of companies which can become multi-baggers in this cycle of IT.
Okay, Vikas, we'll let you go on that note. Good to have you on the show as always.
Thank you, Aisha. Thank you, Nikunj.
Okay, let's just revisit what the market has settled in at. It was the quietest of starts, so no, that excitement from yesterday seems to be done with yesterday, at least for now. 18,786 is where we're trotting around. Idea, of course, is your big mover today. JSW Steel, we'll tell you why. Hindalco, HAL and Hindustan Copper. It's a metals-led move today. Even if I look at the Nifty, Hindalco, Tata Steel, these are the ones which are actually holding out very, very smartly in trade. On the flip side, though, today you're seeing weakness in IEX. Tata Chemicals is down about almost 2%. This Canara Bank, which is down nearly 2.6% as we speak right now. There you go, Tata Chemicals down 3%. Canara Bank as well down almost 3%. HDFC, AMC, and then Persistent is your biggest drag. It's almost 3.5% cut. And this is your top loser within the F&O markets. That's slashed about almost 3.25% as we speak. And metals, yeah, seems to be the sole winner in trade today.
Okay, let's welcome on board Ittara Davis, the MD and CEO at Ujjivan Small Finance Bank, joining us. Hi, thank you so much for making time and speaking with us. I wanted to begin by discussing what you said in your analyst meet recently. You talked about how the bank is all set for a complete turnaround, how you're looking at accelerated growth going forward. Talk to us about that. What are the levers that you see for growth going forward? Which segments are the ones which are seeing maximum traction?
Hi, good morning. It's good to be with ET now. Is today the 14th birthday or is it sometime this week?
Sometime this week. It's on Saturday, but we're celebrating it on Friday.
Okay, great. So in anticipation, happy birthday for that. It's an important milestone. Talking about Ujjivan, we have turned around because we were affected, like many others, by COVID. And as I keep saying, COVID was an act of God, if you look at it from the insurance parlance. But, once the COVID was behind us, the economy turned around. We were managing the situation from the management team at Ujjivan. And in less than 18 months, we have turned around a loss-making situation into the best ever profits for the bank. That is something which is fantastic. And if you look at it from any of the parameters that you would evaluate a financial institution, I would say we are among the best SFBs today in the industry. You can evaluate it based on return on assets, return on equity, cost income ratio, all of those parameters, add it all up, and it comes to equal to the best SFB.
The challenge for the banking sector in last 12-18 months has been there has been a war and war of liabilities. How are you positioned as a bank? Because typically when there is a war of liabilities, it's the larger banks which tend to gain lion market share.
Very good point. And I think liabilities is the engine that drives the business. So, garnering the liabilities at the right cost is the most important part of a banking exercise. So I think this is where perhaps from a long-term perspective, the business model of many of the small finance banks gives us the ability to provide a better interest rate environment for the customers. And you can see the differential in the interest rates between what is offered by small finance banks and what is offered by the larger banks, because the business model allows that. If you look at the net interest income that is available to a small finance bank in its normal business, especially those who have a good mix with micro banking, it is able to offer a little bit more, and that plays to our advantage. And also, it's important to be able to read the interest rate cycles well. We read it well. In August, we made the move. The early mover advantage was with us. We were able to garner the deposits, and before into the fourth quarter, when everybody was scrambling for deposits, we had already taken care of what we needed to end the year with the right sort of book. I think that is what management is all about, and I think that planning and execution perfectly is one of the things that makes the difference.
Mr. Davis, thank you so much for joining in, and thank you so much for your wishes for ET Now.
Thank you.
Right. What I also wanted to talk about with you is geographically, as of now, 50% of your book, as we understand, comes from 4 states. How do you see this mix changing? And are you looking at diversifying, say, in the next 1 to 2 years?
Yeah, we are present. That's one of the ways in which we manage risk. We are present in 25 states today, and later on this year, it will become 26. No other institution in this business is spread over those many states. Now, you're right. We have a little bit more in these 4 states because those are the 4 states where we started, which is primarily Tamil Nadu, Karnataka, and West Bengal. And that I think is seen there. But in no state do we have, our target is to make sure that in no state we have more than 15% of our book. And that is the way in which we spread it. And also we monitor, we have having the brick and mortar on the ground allows us to get a first-hand information about what's happening on the field. And that information is used by our credit teams to decide whether to slow down in any state or any area and to enhance the business in another area. So it is a dynamic force, a dynamic business, using all the information that we get, and that's how we manage the exposures.
Let's understand the restrictions for a small finance bank. And for a small finance bank like Ujjivan or AU, the biggest restriction some would say is that you cannot generate a lot of fee-based income. You cannot sell mutual funds. You cannot sell insurance. At a time when there is one side fintech and when large banks are trying to build a mass cohort of fee-based income, what is the way forward for a small finance bank, because they are running a race with one leg and one hand tied?
But I don't think that is truly the approach, because we have arrangements with 4 or 5 of the insurance companies. We do sell their products through us. So fee income for an insurance from like insurance or even mutual funds, which we are considering to launch, is something that we can do. There is no restriction on that with the small finance banks. There are other restrictions. For example, we have to have 75% of our portfolio has to be PSL. There's no problem for us because we are already, very much into micro banking. So all of those or most of that qualify. Our capital has to be higher than a universal bank. Its minimum CRAR is 15%. But all of that is now well built into the business model. And, if you look at the numbers, it talks for themselves. Whatever the constraints, we have to operate with those constraints. If you call them constraints, I call them, the basis of operation. So, when we look at it, we build that into our model, and that's how we manage the business. And I can assure anybody who's your listener today that the SFB model is a very good model. And here I'd like to draw your attention that certain licenses were given in 1995. Many of those banks don't exist today. In 2015, 10 bank SFB licenses were given out by the RBI. Post-COVID, which is one of the most devastating situations of which happened, all 10 of us are still in business and doing well. So I think that is an indication that the SFB license is a very good license and is a very viable model.
Mr. Davis, what analysts and Street also wants to know is what's going to be a mix between secured, unsecured, and what kind of growth you're envisaging in the micro banking segment.
Yeah, I mean, looking at our book, we have today about 72% is unsecured and 28% secured. We are looking to increase the secured book, by about 5 or 6% this year to make it about 68 or 67, 33, that sort of a mix. And I think that's a good mix to have. And the growth in the secured portfolio is going to come from housing. Last year we went back to the drawing board and have come back with a fantastic housing model, which is able to produce, which is capable of producing, a OSP of 1,500 crores this year if they want to do it. I think, we have going back to the drawing board occasionally helps. And we did that last year for housing. We are doing it this year for MSME and relaunching MSME in the second half. And when that happens, it will be, again, a driving engine to take care of that part and help to build up our secure portfolio. We are happy with the mix, but having a little bit more secure will be, as against unsecured, will help us. And I think that's the direction we are going. And we should be able to achieve a 60-40 mix in 2 to 3 years, in 3 years' time.
Okay. Right, Mr. Davis, really appreciate your time. So glad you could join us. Let's take a break. We were supposed to go closer to 18,800, but we've slipped just not below 18,700, but threatening to go below that, like 14, 15 points here or there. I think it's too early to say that the all-time high will not be made soon. I still continue to believe that we may be off to a soft start, but there are a lot of factors which may be leading that. I think there's underperformance in Reliance. Bajaj Finance has reversed. SBI is not participating. The breadth is not looking all that powerful also, and pharma is just across the board actually. IPCA, Granule, Abbott, Torrent, Divi's. farmers where the problem is. Let's take a break. He joins us now, and it represents Unipath. It's a recent company, just made its debut less than a year ago. I'm going to introduce the company, leading supplier of system and components of off-highway vehicles, that OHV, supplies critical and complex and low-volume multiple SKUs, and they are leader in 3PL and small tractors and global 3PL market share of 16.7%. Mr. Soni, good morning. Thank you for joining us. Now, let's understand the geographies and what's happening to the business. 50% of the business is coming from US, 23% is coming from Europe. Our understanding is that those countries are going through an economic downturn, and your dependence on those markets, in a sense, right now could have impact on the business cycle.
Good morning, and thank you for having me on your show at ET Now. Correct. We are an export-oriented company with the numbers that you've shared about the US and European market in particular. But let's talk about specifically the markets that we are addressing, which is the agricultural equipment market and the construction equipment market. Now, on the agricultural equipment market, I would actually break it up into two. One is serious farming, higher horsepower tractors, which the US is still maintaining a strong growth. And it's only on the smaller tractors that the market is a little soft. But on the OEM side, it is pretty strong. Again, on the European side as well, the agricultural market machinery is a strong indication that we are getting from all our customers. On the construction side, in fact, it is totally strong both in in USA and in Europe, particularly because the $1 trillion infrastructure bill that the USA announced is really playing up pretty well. And the commentary from all our customers in Europe and USA is showing a very strong demand for construction equipment. So we are, in fact, for the current year, looking at a high single-digit growth for the current year, please.
Telling us is that irrespective of what is happening to developed markets, and especially US and Europe, your business is in fine fettle and you will continue to grow.
Correct.
Are you growing because you're gaining market share or the product category is expanding?
So it's a combination of both of them. And, the China Plus One is playing out to giving us a little bit more market share. Clearly, in the higher horsepower, where we only have a 7 to 8% market share, that is growing because of the patent that we took on a particular part. And we have, in fact, new business on the higher horsepower from customers like Casey Holland and AGCO. And clearly, on the construction side, we have, in fact, added a new customer in Korea. Our sales with the largest company in the US is going very well. We continue to attract more business. In fact, the business run rate attraction is now running at about 300 crores a year, out of which 90 crores has been put into production already in the last quarter.
Mr. Soni, you talked about how FY24 is likely to see a high single digit again in terms of the revenue. But what about the margins? Because the margins were very volatile on a quarterly basis, but at least on an annual basis, you're close to 23%. In FY24, what could be that number?
So, we did close to 22% last year, but there was, other income as well. But I normally say my company is like a 21, 14, 7, three numbers. So about a 21% EBITDA company with a 14% PAT and 7% free cash. And having said about free cash, even though we say 7%, last year the cash generation was 252 crores because we were able to cut down our accounts payable and accounts receivables, and balance them off.
Soni, the other thing I also wanted to understand, about the new order pipeline, how's that looking like? And whether or not you're looking at focusing on a particular part of the portfolio in terms of the product, the product bouquet that you have, or looking at diversifying further, any new product additions that you may be looking at making?
Good you asked that question. In fact, under our agriculture and what we call as a three-point linkage system, we have actually developed a new system for UTVs and ATVs, particularly for the USA market. This market, in fact, is panning out to be larger than the less than 70 horsepower tractor market for 3PL that we have in USA. In fact, the largest customer in the world that we have for this product has just placed their initial orders with us, and we really see a lot more growing. This is entirely a new area that we are growing into under the three-point linkage in the agricultural market.
In your presentation, you also talk about how one of the levers of growth is going to be inorganic through strategic acquisition and alliances. Talk to us about that. What's in the pipeline?
Definitely, we are actually looking at some organic, inorganic add-ons, but it's a little bit too early to talk about them. But when I talk about a growth level of in high single digits, that's completely inorganic here.
Like the high single digit is organic, but in terms of the acquisition, if you can't give the details, at least the nature of the acquisition, is it going to be a company with some new product profile? Is it going to be in the US region, Europe region? What's the kitty size you have in mind for such acquisitions?
Correct. So we are looking both in USA and Europe. Our bent of mind is more toward the US because of the ease of doing business over there. We are looking at anything with a top line of between 100 to 150 million dollars. We are looking into areas like you mentioned that we are in the three-point linkage and the parts for the construction machinery, what we call as PMP. Within the same customer base that we have, we are also growing into hydraulics and as well as other areas, and we are looking at acquiring companies in these new additional places, which will definitely help us to increase our overall business.
Now, well, you're sounding optimistic, but I'm looking at your Q4 numbers. The margins came down from 25.8, about 26 to 21. EBITDA came down from 85 to 70. Is this largely because of seasonality, or Q4 was an exceptional?
Okay, it was in Q3 and Q4, both were exceptional. Q3 because, the exchange rate, the euro went up dramatically from that 82, 83 level to 89 level. And the US dollar also helped us at that stage. But more so in Q4, both two of the things are passed through for us with our customers. One is steel as a commodity and the other is sea freight. And we saw both of them coming off, so they were affecting our top line to some extent. Also, because the sea freights have come off, in fact, are almost at the pre-COVID levels, we have also seen that the time it took for material to reach Europe and USA has cut down by about 30 to 35 days. And therefore, there is this huge buildup of inventory in the system that is now coming off, and that is what led to some of the lower numbers for Q4. But if you look at the complete full year, we were clearly EBITDA was at 22.9% and we grew at 15.3% and the PAT was grew by 22.4%.
Okay, great. Good to have you, Mrs. Soni, and certainly appreciate much more of you going forward.
Thank you, and really appreciate you having us on your show as well. Thank you. Bye.
Thank you very much, sir. You got crazy move in Trent, crazy move in Tata Com. Big move is now sustaining in Z. When I say big move, not in percentage terms but from yesterday's low. What is happening in Tata stocks, man? Tata Consumer up 4%. Tata Com is up another 4%. Trent is up 1%. Tata Power is up 1%. Tata Motor is up 1%. Well, say hello to Tata Group of companies. That's what I can say. It's interesting that if I look at HDFC Group of names, all of them have slipped. HDFC AMC, HDFC Insurance, HDFC Bank. In last 1 year, if there is one group which has not, last 2 years I would say, one group which has lacked any kind of a serious wealth creation, I think are HDFC Group of names. Last 2-3 years, if there is one group which has created a lot of wealth, is Tata's. Last 2 years, if there is one group which in a sense has been very volatile in terms of its wealth creation map, it's Adani. And Birla Group, if you look at the sum total of, let's say, Grasim, Ultratech, AB Birla Financials, With the exception of AB Birla Financials and Ultratech, the Birla group of stocks also in last 1 year have not really created a lot of hoo-ha. Now producer will struggle to keep in pace because I'm just saying names. But yeah, Tata group of companies today are having an exceptionally strong field day. Indian manufacturing sector also is having a very strong field day. And we are sitting with that theme from Unipaths to Dixon Technology. Saurabh Gupta, CFO of Dixon Technology, joins us now. Saurabh, good morning. Thank you for joining us. Always good to have you back on ET now. Saurabh, there is perhaps a mandate from the government now that the Chinese mobile companies will have to look for Indian companies as equity partners when it comes to manufacturing phones now. How important is that? Is this already at play? And what does this mean for Dixon?
Yeah, so I also read this news yesterday. So clearly, yes, more and more Chinese companies have been asked to partner with Indian companies. So that's good for the overall Indian manufacturing story and Indian companies, growth of Indian companies. So clearly, I see that. I clearly see it as a positive step in the whole Indian manufacturing story.
Currently, do you currently have association or partnership with any of the Chinese brand for whom you are manufacturing at Dixon?
So we are manufacturing for a lot of Chinese companies. If you look at in TVs, we manufacture for Xiaomi, we manufacture for Hisense, and in mobiles also we have recently announced a partnership with Xiaomi. So clearly, at an overall portfolio level, Chinese companies, we work with them, and we are an EMS player to them.
Well, yes, Saurabh, you also have a partnership with Xiaomi, right, that you pointed out. What is the revenue potential from that? Because you recently extended your partnership with them. And overall, for the mobile segment, what kind of growth are you penciling in?
So I would say, without putting into numbers, it can be a very large opportunity. Xiaomi is definitely among the top 3 brands in Indian market. They have a very large market share, and Indian market is a growing market. So clearly, presently, those audits are going on. Those infrastructure ramp up is happening, and we expect to start production for them in H2 of this financial year. Overall, I can clearly say that it can be a large opportunity. They're a very large player in the Indian market, and we have so far had very good relationship with them on the TV side. We do a significant portion of the TV requirements in India, and hopefully we should be able to replicate that on the mobile side as well.
Will the synergies from this deal reflect on your books? Which quarter?
We will start executing the manufacturing from Q3 of this financial year, H2 of this financial year.
Sure, just wanted to come back to that point, Saurabh. Any initial talks at all with the likes of Xiaomi on account of that equity partnership which government is talking about? And if yes, if it does fructify, what kind of partnership would that be?
No, sir, there have been no such kind of discussions with them.
Okay, so no such conversations at this point of time. But in Q4, you had indicated that two mobile phone large deals in the pipeline. One has fructified. Which is the other one, and when can we hear about it?
So other one is also a fairly large opportunity. Of course, not on the same lines as Xiaomi, but clearly it's also a large opportunity. So those also is in very advanced stages, and hopefully, if everything goes well, we should be able to conclude in the next couple of months. And there also the execution, we are hopeful, should start from Q3 of this financial year.
Again, a Chinese or an Eastern player?
I can't tell you anything more. It will be premature, and it's not out in the public domain. So I won't be able to tell anything.
Sure, I was just trying my luck at it. We'll wait for the official information. But tell me, given that there's one deal already happening, the other one is in the pipeline, you must be looking at raising more money as well, right, for CapEx?
Yeah, so if you look at our balance sheet, we just have a gross debt of 0.14x. So clearly there's enough cushion in the balance sheet to raise more debt. And as you think, the earnings will significantly improve this year. So we have budgeted a capex of 450 crores, and that was the going run rate for the last couple of years as well. My sense is we can easily take more leverage in the balance sheet if required. So probably between the internal accruals and some bit of debt, I think so we should be able to fund this kind of growth. And if required for some more opportunities coming our way, then yes, we might go to the market to raise equity. But as of now, I feel confident that it can be done from internal accruals and some more debt on the balance sheet.
So last year 12,000 crore, 15,000 crore FY24. Last year turnover 12,000 crore. 15,000 is what we should expect this year as a bare minimum, because the Chinese company will come in, your contracts are getting added. So 15,000 is a reasonable number, right?
Again, I don't want to give any number because last year we gave a number, and I think so. There are a lot of factors which are also outside your control. There can always be delays in execution. There can always be delay in agreement closures. So clearly, my sense, we will have a very large growth, and clearly the visibility looks very positive, and we are almost on the closures now. So my sense is we'll have a very large growth and will significantly outperform the industry growth this year.
Significantly outperform the industry, and I'm hoping it will come with a margin of around 4.25 to 4.5%. That is what at least you had initially guided for FY24. But before we let you go, can you just talk to us about the PLI schemes as well? What kind of additional revenue are you expecting, and any more such PLI schemes in the pipeline that you are bidding for?
So we are the largest beneficiary of PLI schemes. So mobile is the largest. We are, of course, we are the only company which has actually got the incentives till FY December 2022. And we have customers like Motorola, Nokia, and now Xiaomi, and also more customers are in the pipeline. And then we are a beneficiary for telecom and networking products PLI, where Bharti is our JV partner and Airtel is an anchor customer. There also we are looking for more customer acquisitions. Third is IT hardware, where the revised IT hardware scheme has come in, which has the government has increased the budgetary outlay and the incentive percentage. So we are in discussion with some large brands, and we'll have a better visibility over the next few months. And apart from that, we are beneficiary under the lighting components PLI and AC components PLI. So my sense is all those PLIs, the revenues have started in some of the cases. Mobile, we have already done our capex. So some we have already achieved a threshold. Some we will achieve a threshold this year. So clearly, we are at the forefront of all the PLIs. I think so. We are the only company which is a beneficiary of 5 PLIs of the government.
Okay, good luck for that, Saurabh. Great to have you on ET Now and chat with us.
Thank you very much. Thank you.
Okay, let's move on and let's help you make some money and get in some prizes. Unlock a golden opportunity with us at ET Now. On a 14th birthday, here's a gift for you. Participate in ET Now's Force of 14 contest and stand a chance to win 14 gold vouchers. On our 14th birthday, all you have to do is watch ET Now through the week, give a missed call on 888-665-9273 and grab the golden chance. Today's second question is, who is the managing editor of ET Now? I repeat, who is the managing editor of ET Now? Your options are Navika Kumar, Nikunj Dalmia, Nikunj Gar, and Rahul Shivshankar.
ET Now has turned 14, and the golden celebration is on us. Watch ET Now on 12th to 16th June during the market hours from 9 a.m. to 12 noon. All you need to do is just answer one question every hour. To participate, give a missed call on 888-665-9273 and answer the question. 14 winners will stand a chance to win gold vouchers. It's raining gold with ET Now. Rise with India.
Okay, let's move on and let's talk charts. Kunal clearly can't take his eyes away from Maruti. Can you, Kunal?
Absolutely, Aisha. And the setup for Maruti is very, very interesting because it's now come back towards a major support zone for itself. Now, this is the trend line or the upward rising channel for Maruti over the last 2 months. This was a point when the stock was at the 9,000 mark, I think 8,500 approximately, where the stock made a swing low for itself. Look at the pattern over here. The stock has been consistently trying to take support as well as resistances at this trend line. So this forms a major support point or the support trend line for Maruti. This was the point when the stock took a bottom or took support, formed a bottom as well as managed to rise up, come back towards the upper end of the trend line where it found resistance. And again, this was the point where the stock took support. The setup over here is a bullish hammer pattern on both of the accounts where the stock took support. Even on the third count where this was the end of May, start of the month of June, the stock formed almost like a bullish hammer pattern over here, established a bottom, took support at this trend line, and then managed to come back to the hard in the trend line support. So this time around, I would expect something very similar for Maruti. If the stock comes back towards say 9,500 or slightly below those levels, I would believe that the risk reward to initiate a buy could be extremely lucrative, and then we can hopefully expect the stock to come back towards its previous highs and break past about this trend line resistance of 9,900. So the risk reward is extremely lucrative, expecting Maruti to come back towards 9,900 plus levels in the next couple of weeks.
Right. Okay, let's move on and let's talk some individual stocks as well. Kunal, what's on your radar there?
So I would suggest a couple of buy calls, expecting that the market rally and the trend would continue for the index over the near term. So the two calls which I would suggest for short-term traders would be United Spirits. I think it's almost at 897, 898 levels. Would expect the stock to rally towards 980. Stop loss for this trade is at 860 mark. And the second would be one IDFC First Bank, again a stock which has regained momentum after a few days of consolidation. So targets of 80, stop loss at 74.
Okay, Kunal, we'll see you again later in the day. But JSW Steel, that's another stock which has been soaring away in an otherwise flat market after the Economic Times reported that Sajjan Jindal is picking up about 45 to 48% stake in MG Motor India, a wholly owned subsidiary of Chinese company SAIC. But remember, we told you this back in April on the 24th. In fact, Ajay is here with more details on what exactly is the deal and what could it really mean for the company and the industry per se. Ajay?
Well, that's correct. We told our viewers on April 24th that Sajjan Jindal and his group are circling a big chunky stake in MG Motor India. Today, of course, JSW Holdings is gaining 7% in trade along with JSW Steel and even to a certain extent JSW Energy. But let me tell you that our sources said that the listed entities may not have anything to do directly with this transaction. What we understand is that it's the family office of JSW, of Sajjan Jindal, which will be picking up anywhere between 45 to 48% stake in MG Motor India. And they are not only looking at MG Motor India, they are even looking at some of the other EV companies like BYD, etc., as per our news. But right now the focus is on MG Motor India because of its EV capabilities. It is still expanding its capacities, and MG Motor India does require funds. The entire company is valued close to around 24,000 crore. So 48% will be picked up by Mr. Jindal and his family office, and rest around 4 to 10% would be with employees and dealers of MG Motor India. Our sources say so. This way the transaction would be structured. Remaining stake will be held by the main company MG Motor parent China. So what happens this way is the Indian companies, the Indian owners, including the dealers, employees and the larger one, in this case Sajjan Jindal and his family office, will hold over 51%. So the necessary condition that 51% should be with Indian ownership, that gets satisfied, and we understand that it is actually moving forward. In the next few weeks itself, a transaction could be announced officially. Indirectly, what it does is for the group, which has got very big ambition in renewable energy, green energy, and JSW Energy could be the vehicle. Indirectly, the benefit would be going there, but directly there is no like-to-like comparison. It is important because JSW Steel, JSW Group is one of the largest groups among the top 5. Their direct entry into EV, apart from the traditional auto companies or even startups, so this is likely to shake up the ecosystem and invigorate the entire ecosystem definitely. But this is a very interesting story which is developing, and we understand it's moving forward very speedily.
Now what it means very simple, Ajay. Tatas have already got an ecosystem in the electric vehicle. So Tata Power is making the charging station. Tata Chemical is making the batteries. Tata Motor is making the EV vehicle cars. Now JSW Steel or JSW Group is coming indirectly. They already have power. They are buying a they are buying a 40% stake in a EV company, and now they would be investing in creating the infrastructure business. So it is like saying that this is an indirect way where JSW Energy is going to be doing what Tatas have done in creating a entire ecosystem for the electric vehicles. Right, Ajay?
Correct, Nikunj. As the renewable and the green ambitions of the Tata Group mostly get captured in Tata Power and partly in Tata Chemical. This way, JSW Group's EV and renewable energy, all those ambitions will be partly would come indirectly to energy, and mostly as a transaction. This transaction we're talking about right now would be at the parent level.
Great story break. Meanwhile, there's Tata Consumer and Tata Coffee. Just a coincidence that anything which has got a prefix Tata and suffix Tata, that's doing well. There is definitely no correlation between Tata Steel and a Tata Power and a Tata Consumer and a Tata Com. All of them are very different business, I can assure you that. Let's take a break. When we come back, there are very interesting data where how many croropatis HUL has made. We always think about how many croropatis the startup guys have made. HUL also is claiming that how many croropatis they've made in the annual report. We'll talk about the data when we come back.